Delighted to be joined by Michael Muldner, who's been in the industry for nearly 20 years, serving in different functions within distribution, legal and compliance, and has just left Nordea. Good man, Michael. Cécile.
Yep.
Cécile from Tikehau Capital, where she joined in 2013 as head of private debt activity. And to date, she's arranged over 150 financing transactions and was one of the pioneers of private debt strategy. Welcome. Matthew.
Hello.
Matthew Maguire from Park Square. Matthew, you sound very English, are you?
I am definitely English.
And I understand that you've got a black belt.
That is true, yes.
So you're a Taekwondo expert.
I'd say I'm more a private debt expert these days, but I do try.
Okay, so I understand that you were previously the UK champion in Taekwondo.
That's also true. You've got
Goodness gracious me,
good
okay. We won't disagree, I promise. But indeed, he's now a director at Park Square Capital on the ESG Committee and AIFM Valuation Committee. Previously worked at PwC as well. Thank you very much. Good to have you with us, Matthew. Biljana, welcome. Biljana from MV Credit is the conducting officer for portfolio management, previously with M&G, where she served as the country head for its Finnish branch. Very big welcome to you, Biljana. And finally, Lucas Eckhart from Golding Capital Partners. He's a director conducting officer. He joined Golding back in 2018, responsible for risk management, valuation, and monitoring. Big welcome to you, Lucas.
Thank you, Jim. And let me tell the audience, actually, that LPEA has given us really a big challenge because we have here a very distinguished panel for very talented, experienced, and skilled people, but they only have given us 30 minutes to talk about private debt. So just for you to know, we actually have deliberately decided to keep the answers short. I will also keep my questions short. And if you have anything else that you would like to touch upon with us later on, please try to grab us. We will be around. But let's get on to the topic, private debt 2023, the year of private debt. That's at least what we have given this session a title. And obviously, there have been many topics that have already been raised earlier today. Rising interest rates, we also see that actually private debt is providing very attractive risk-adjusted returns, while at the same time, obviously, there's an ever-increasing demand for corporate funding, while basically banks are disintermediating more and more. All this obviously sounds very promising, but at the same time, we also basically have to see that institutional investors, they have been allocating money to private debt. They are actually eyeing private debt to allocate much more. Now the elephant in the room, investor types are coming to the table and want to get a share of the cake of private debt, talking democratization. So there's quite a lot of topics private debt is actually having right now. We will try to address some of them. And let me probably start off with the first question. It's 5 simple words, so why private debt right now? It's probably an easy question, but not probably so easy to answer. So Matthew, first question to you. Why private debt right now?
Well, I think the environment that you've just described is probably the best investing environment that we've seen in our near 2-decade track record at Park Square. To be predominantly floating rate in a rising rate environment is just phenomenal. So to put it in perspective, when we're negotiating deals, we're normally fighting for every 5 or 10 basis points of yield. And to see nearly 500 basis points pick up over the course of 12 to 18 months is just phenomenal for us as investors and for our LPs. And I think the second thing is we've seen decreasing competition over the past 18 months or so. And that's not from the other private lenders, but it's from the banks, who have really been sat on the sidelines, hamstrung by a number of very large hung syndications. And private lenders have really capitalized during that time period, taking market share and also negotiating better structures, better terms for their investors, more defensive capital stacks with bigger equity cushions. So for me, sitting there, being able to achieve net returns of sort of mid-teens on our junior debt strategies, that's a phenomenal risk-adjusted return and also a great absolute return in the current market. So we feel really good about the current position we're in.
Thank you very much for that, Matthew. And actually, when taking it on to Biljana, because actually you mentioned something when we had our prep discussion earlier, and you said actually private debt has become a strategic bet. What do you mean?
I will echo what Matthew said just now and maybe take one step back. And MV Credit has, like Park Square, been investing for a while in private credit for more than 20 years now. And during that time, I think we've seen that the asset class has become a strategic allocation. It has a strategic allocation place in the institutional portfolios, so the popularity among institutional investors has been growing steadily. So it is a strategic building block, building block in the portfolios, and it's been for a while. From a more tactical point of view, I agree with Matthew. What we see today is proof that the asset class remains very resilient. We've seen a few headwinds in recent years. We've seen the pressures from the supply chain that COVID brought. The asset class has weathered these quite well. We've seen labor market stress, which has also been weathered well. Inflationary pressures, most of our borrowers at least have been able to meet this with increasing prices, and these price increases have been relatively sticky. So we come to today where actually for quite a while now, for the first time maybe in a generation of investors, we see now a rising interest rate environment. And this is the latest challenge. We see that some of our companies are seeing their interest burdens increasing substantially. It is evident in their use of cash, and it shows some financial weaknesses surfacing. But I think that these just examples. Overall, the asset class remains strong. And as we said, the fundamentals remain strong. Also on the supply-demand, what you mentioned, a very long trend of disintermediation, private lending moving away from the banks, and we've seen that already happening or has happened in the US, and the trend is now becoming stronger in Europe. This movement from bank financing to private financing is getting stronger. And coupled with the demand for more complex solutions that we see today from borrowers, I think that the importance of private lenders is increasing. We have, repeating again, better terms. We have seen strong opportunities to negotiate with the borrowers and also to engage on constructive topics like sustainability, for example, when speaking with them.
And let me just chip in on that one, please, Biljana, because you mentioned also a few times now challenges and pressures, because pressure is also something that we have seen on the regulatory side, right? Lucas, isn't that something that you also see on your end?
Yes, actually at Golding, we, like Matthew and Biljana told already, experienced great and stable returns over the last years in our portfolios. It is a great situation on the interest side as well, but and the competitive environment improved drastically around the last years because due to heavier regulation, traditional lenders like banks got tied up more and more in regulation and left slowly but steadily the stage to open the floor for private credit players that placed funds, that financed the economy. We believe, let's say, putting all factors together, that it's a great time for private debt and that investor allocation will float further into the asset class and increase the relative and as well the absolute share.
Well, when you all basically say that seems to be the right time now for private debt, right? So private debt in that sense probably has arrived into the mainstream, right, Cecile?
Yeah, indeed. So sorry for those of you who have been in some conference lately. I'm sure you've heard this before because indeed this panel is titled The Year of Private Debt. You heard this everywhere. And needless to say, you have the very large US asset allocator and asset manager claiming all over the place that private debt is actually the place to be, and that's really a mainstream trend. In a way, I'm a bit biased myself because when we started many years ago, that was a bit this type of alternative asset class being referred as shadow banking, behind the scene, behind the curtain. So we were actually arranging and supporting companies with very bespoke solution. And now all of a sudden, because of actually a lot of its intrinsic merits of this asset class, it has developed and become really mainstream. Just to share some data, also sorry for those who have heard this before because it's in every article currently. It's today $1.5 trillion worldwide as an AUM, with this perspective to reach by 2028 2.8 trillion. So needless to say that it's only within 5 years it will almost double its size, meaning that there will be really becoming very established and a long-term trend. And as indeed Biljana has explained, that has been this long trend, secular shift to from more or less banking to more private held type of funds, with a very now broadened scope, which is not only these closed-end funds, but it's also reason for this acceleration is that you have more and more format targeting actually the retail market. There is this democratization or retailization of the market, which is capturing also the private debt, which again was very below the radar and nobody was very well aware of this type of financing. And now it's really head-to-head, and you as a CFO of company or private equity sponsor, who usually are the main actually user, quote unquote, of this type of financing, they explore really independently, and for them it's a bit same. It's not by default no anymore, and so they will explore a bank solution versus a private debt fund solution, and that has become really now in terms of size and reach very widespread again, and with this specificity, which is very still important to remain extremely tailor-made, which makes also one of its key merit and its success today, because we go and have this kind of unique one-stop solution and engage in detail with company, are acting as a partner and not just as a pure kind of commodity style type of engagement with companies.
Thank you, Cecile, and it's quite kind of you that you say that you're probably a bit biased, because maybe the audience doesn't know, but actually Cecile and her team, they have been raising one of the 5 largest private debt funds last year, so congrats to that again. But at the same time, I mean, everyone in the audience listening to you, basically, if not yet invested in private debt, they would feel urged now to basically get into it and try to invest, right? But every opportunity usually comes with certain types of risks. So, Matthew, what do you see there? What should I consider there in terms of risks?
I mean, the flip side to the rising base rates being a big positive for the fund structures is the impact that it has on the portfolio companies themselves, who are facing higher interest costs, but also higher input costs because of the inflationary backdrop that we're seeing. And I think with the continued macro events that we're seeing in the world, it's clear that central banks are going to keep base rates high for a longer period than perhaps we first realized. And that's putting a lot of pressure on portfolio companies, particularly those who are perhaps not able to pass on price increases, as referenced earlier, or have unsustainable capital structures that will need creative financing solutions to solve. So I think it's clear that a trend moving forwards is going to be an environment of higher defaults. And that's going to put pressure on portfolios. And I think it's going to expose some of the managers in the market who have perhaps been more aggressive in their scaling of their businesses. But I think those managers that have maintained investment discipline, focused on stable, defensively positioned companies, we'll do just fine. But it's a really important time to be fully focused on portfolio monitoring, fully disciplined on your investment selection, and really making sure that you're picking the highest quality credits that are out there.
Thank you, Messian. Unless my counting is wrong, you mentioned 4 times the word discipline. And discipline is also certainly something that probably is worth taking into consideration, especially when doing the due diligence. So, Biljana, how would you basically advise people on the due diligence side?
I think that all of us on stage are credit investors, and I don't think that at any stage of in the cycle do we go into investments without proper homework. To be honest, I think this is the bread and butter of our business. The type of asset class we invest is with limited upside and unlimited downside, which gives the right motivation to do proper due diligence before you actually invest. And I echo the prudent, patient, disciplined deployment of capital is alpha and omega at any stage in the cycle, and even more now. So yes, proper credit due diligence, proper sufficient appraisal of the covenants and other legal protections that you might find in the documentation, prudent analysis, adequate pricing of risk, and I think this is where experience comes from, knowing where things usually go bad and how to price that risk correctly. And meeting the management, meeting the peers, meeting the suppliers, meeting the customers of potential borrowers is very important, and not least doing proper analysis of any potential sustainability risk. As we heard many times in the presentations this morning, these risks are becoming material for any business, including the borrowers or the target as borrowers or corporates that we have in our site. So I think that we achieve this our targets mainly by preventing accidents and monitoring ongoing, so the pre-investment due diligence, but also ongoing monitoring for early signs of distress, where we can engage on time and help our investees deal with potential issues in a timely and efficient manner.
Thank you, Biljana. And actually, you mentioned taking risks, pricing risks. So maybe we can take benefit of the fact that we have a conducting officer risk management in our round here, Lucas. So that's obviously something that also from risk management point of view, and actually also the procedures, the processes that you build in order to also give comfort to your investors, that you always have to take into very close consideration. How do you do that?
Yeah, maybe some brief comments from the machine room of risk management. Actually, for us, risk management spreads as part of the fiduciary duty from front to back. So actually, we start, like two of you already alluded to already, it all starts with disciplined due diligence and disciplined lender selection, of course, in order to try to avoid losers. It goes on, like, for example, we try to focus on businesses that have a stable and non-cyclable business model with recurring revenues. We, for example, love, if we go on the direct side, we love software as a service businesses. It is, let's say, I would call it the front side of risk management. It continues with underwriting standards. So you try on the legal documentation, on the terms and conditions of the lending instruments to get downside protections, to get covenants in place, and to get it in place that if something goes wrong, you're protected. Furthermore, when we go to the holding period of a debt instrument, of course, monitoring is the heart of risk management, and here we're usually looking at, first of all, the business plan and the business plan achievement of the borrower. On the other side, on covenants and on financial operational covenants, like LTV, like leverage ratio, like interest coverage ratio. And last but not least, on the default rates in the portfolio. But this is more on from my perspective, if something goes wrong, then I would recommend to have some restructuring or refinancing expertise in the company that could solve some tricky situations.
Thank you for that, Lucas. Now basically the audience know why basically going into private debt. They also know what to consider from a risk and also probably from what to consider from a governance point of view. Let's also probably quickly turn an eye to the fact, whom do we actually want to sell private debt to? So we have been hearing earlier today a lot about democratization and retail investors coming to the table. So the question that I was wondering about, is actually private debt more still for the institutional investor, or is it actually meant for everyone? Cecile, do you have a view on that?
Yeah, I alluded to this a bit earlier, and indeed that's a big change in this market approach, in the sense that it was open and mainly supported and fueled by pension fund, insurance company. Insurance company really, in a way, allocated in the private debt as a kind of sidecar of their fixed income, and or sometimes as part of the private equity, and that was in between. That's all started mainly driven by the mezzanine, where it was precisely in between and people didn't know where to allocate. And then gradually that has shifted and has become, as I mentioned already, independent and a private asset on its own. And then that has been really a time, and that has really been a catalyst, I think, over the last now 2 years, that there is more and more way to reach out to retail investors and the more apps, fintech style and so on. And then all of a sudden the feeder approach and the retail network of banks have been open to propose these private debt underlying products to mass market in a way, and you have different solutions targeting high net worth individual, but also more mainstream again. And that's what, just to share some examples, that's what we have done at Tikeo in partnership with some insurance company, because that's where the key actually limit of this retailization is to make sure that there is some liquidity. You will see more and more funds, private debt becoming evergreen with this access to becoming features as semi-liquid, and that's where there could be a big potential limit here, in the sense that you are trying to have a liability which is short-term in a way, or looking for liquidity, and at the same time on the asset side you're going to actually finance company long-term. So there is this need to find out solution to come up with liquidity, and that's where we have teamed up with insurance groups and providing, so in a format of insurance life contracts with unit links approach, and that's now opening, and with this very big success, in the sense that because private debt precisely is proposing cash interest payment usually, so you have this cash coupon as opposed to the private equity where you have the G curve and you commit year 1 and you wait until year 8 to get some exit or some cash out. Here it's on a quarterly basis. You can have some cash stream, and that's very important, and that's how we think that it's becoming really very well a major source of actually fundraising now. And I think again the most established private debt player will really tap onto this market. Yeah.
Thank you, Cecile. And actually, you mentioned very many very good points. One of the points also that I would like to continue with is actually the fact that democratization actually also quite often is seen in the context of fund of funds. fund of funds as entry points. I mean, I know for a fact that looking at the PE big shots, very many of them have launched in the last 9 to 12 months new vehicles here in Luxembourg. So there is certainly a demand or market for it. Lucas, on your end, you having fund of funds very close to your heart and your offering, how do you see that? How is basically the clientele fit for private debt?
What we actually heard today in different sessions as well, and what we experienced as well, is that the market change at the last, I would say, up to 5 years, that traditional, that first of all, players like Moonfair, like Titan Bay, like this, I would call them accessors, opened up for non-institutional investors. Then fund of funds moved ahead, then traditional private market players followed. I mean, nowadays there are cooperations between private market players and fund of funds and banks that play the game to tackle the multi-trillion dollar non-institutional money. What I can bring from my experience, because we're setting up a project where we're since, I would say, half a quarter year there, setting up a project there. I would say the main, and quite anecdotal, the main 3 challenges I can bring is, first of all, it's about business model change and distribution strategies, thinking about sales. So, because when we see at classical private market firms, they know huge investor tickets, they know few investors per fund, and they just don't, let's say at the first time, they cannot cope with the new investor requirements that come with retail, that come with high net worth, or that come with family office tickets. And there we saw really that we have to adapt first our sales strategy. We have to adapt, we have to think about distribution, how to distribute, where to distribute, and as well how to set up the whole distribution framework. Second, which is a point that follows the first one, product structuring and choice of vehicle plays a big role here as well, because you want actually to create something that investors will invest. And for that, you need new features. You need that usually fulfill the requirements. Like you alluded to, liquidity is a big thing, or a closed-ended versus open-ended capital call mechanisms. Most, I would call retail investors, don't know what a capital call is. So you have to adapt your product structuring. And last but not least, and for me one of the biggest points is the operational side and the operational challenge to set up your fund ecosystem onto this new kind of business model, to set up your distribution channels, to make everything as well work on the operations, that everything works efficiently together. And like the speaker before us said as well, I think there's huge potential in automatization and digitalization. And we're on overtime, so I hand back to you.
Thank you for that. And I promise we will be done in a few minutes. Jim, please give us that. Quickly to you also, Biljana, because Lucas mentioned distribution strategy. Distribution strategies have to converge. Can you tell us more about that?
At MV Credit, we've been managing a product of offering a daily liquidity, daily NAV as an exposure to private credit. And from my experience, in addition to the topics already highlighted, I have to mention also it requires a different approach to portfolio construction to manage liquidity and cash drag in a different way. We manage a subscription redemption model rather than capital call model, which again requires different operational models. In terms of the access to new investors, I like the term mutualization that was mentioned earlier today. We need to be very careful to make sure that the end investors of our products understand what they're buying. The fact that a person has a lot of money doesn't mean that the person understands private debt as an asset class. So a lot of work needs to be done with the distribution intermediaries to make sure that there is no risk of mis-selling and that the investors understand the profile, mostly the liquidity profile of the asset class, and there is no risk of investment horizon mismatch, to put it in more professional terms. But again, also the ecosystem, having the right service providers to service this type of product is very, very important, and very, very close relationship.
No worries, Biljana.
Close relationships with the distribution network and with the intermediaries to educate the investors.
Thank you, Biljana. And knowing we're already over time, one last question to each of you, and please answer with one sentence. 2023, the year, or is actually more the years to come of private debt. What's your view? Biljana, would you want to start? One sentence, please.
Last words.
Last word.
Are we there?
Good.
We're already there. Well, if we have to say last words, equity-like returns with less uncertainty. If one manages and correctly prices the credit risk, I think this is a good vintage to enter and achieve returns that listed equities have delivered over the very long term. With the correct mindset and a very patient investment approach, I think this is achievable.
Thank you, Biljana. Lucas.
I would say with all factors combined, it could be one of the great vintages of the century.
Thank you. Matthew.
Floating rates, contractually committed returns, and really strong equity cushions. What's not to love?
Very clear. Cecile.
And just to conclude, that's the place to be. It's the cool for the investors. We mentioned the best risk return ever. The cool for the company because it's reliable and we can deliver financing, and cool for the team because I think it's very interesting to work in a private debt fund.
Super. Thank you all. Thanks for listening.